Everyone's always talking about volume this and volume that, but how do you really use volume to your advantage? And how do you really understand and read volume? If you stay tuned for this video, I'll be going over the basics of volume and using it to your advantage. Let's get into this. Now, I'm sure you've probably seen a volume chart before. It's typically at the bottom of your main chart in the little subgraph. And usually it's like a bar chart, and it's usually green or red depending on how the candle closed. And just at a surface level understanding, volume means how many shares have been traded that day or have exchanged hands. For example, a stock like Tesla typically trades about 30 million shares on the day, and a stock like Google trades about 3 million shares on the day. It can use this understanding of volume to understand how liquid or illiquid a stock is. A stock like Tesla is extremely liquid. It's really easy to get in and out the position. A stock like Google, there's going to be a wider spread. It's going to be a lot harder to get in and out of positions. Now, I recommend checking out this book. It goes over volume extremely well, and I learned a lot from it, and I recommend it to everybody if you want to go deeper into volume and understanding it. But moving forward, there's a few things to look for when reading volume. One, you're gauging interest in the market and if there's market participants or people currently trading in the market. If you have a low volume day, like before an economic release, you're probably going to see a lot of chop, or the market or the price is moving sideways and there's not a lot to trade. You can see this in the volume and there's not a lot of interest. And suddenly after the economic release like FOMC, there's a huge surge of volume, and all the market makers and participants come back into the market and start trading, moving the market, and there's huge volatility. It should be represented in the volume. And this kind of goes forward into cause and effect. If there's a bunch of volume coming into a stock, there's a bunch of interest, you should see that represented in volume. And the candle should be trading a bigger range if there's more volume. And if they're not moving in a bigger range, that goes on the second point. It could be a sign of reversal. If price is plunging, then all of a sudden randomly you see a huge volume candle and has a huge lower wick or upper wick, that could be a sign of reversal. And that means that buyers are finally stepping into the market, or sellers are trying to stop the market from going higher. And this is called stopping volume, where you see the most volume on the day, representing that buyers or sellers are trying to stop the price from continuing higher or lower. And this is also a key thing to look for in a reversal. 3, if you trade breakouts, you definitely want to look at volume for continuation. If you don't see the volume continuation, it could be a sign that buyers or sellers are getting exhausted and price could continue to slow down, or that the trend is about to change. And this is represented in the volume, as I just mentioned. And the fourth one, and the most important factor in volume is what moves the market. You may have all these fancy indicators like the RSI and the MACD, but these indicators don't take into account volume, which is what moves the market. You can use them to take trade signals off of, but they're going to be lagging indicators, and they're not taking into account volume. And this is why I recommend using things like key levels, supply and demand, the 9 EMA, all in tandem with volume to get a really big confluence area and take higher quality trades. And it will save you for low risk, high reward trade setups. I'll show you a few examples of how you can use volume to take better trades. Now we're inside of Thinkorswim and we're looking at the volume subgraph. I'm gonna give you guys 3 seconds to tell me which day do you think had the most volatile movement and the price action was the best. I'll give you 3 seconds. Alright, well, if you said this day right here, this Thursday,
you was right.
Just by volume alone, you can look and see that there's this stock in particular was moving about 1 million shares every 5 minutes compared to these 2 days right here on Tuesday and Wednesday. Now, let's see what stock we're talking about. We're talking about the infamous AMC stock. Now, this is what I always tell people. If they just wait for AMC to get volume into the stock instead of trying to trade this, you know, I'm not even sure what to call this price action right here, garbage price action. And they wait for days like this where there's clearly buyers in the market. They're trading huge volume the entire day, consistently almost 800,000 volume, 800 shares every 5 minutes. If people just wait to trade these days where volume is consistently going up, instead of trying to trade days like this where volume's, you know, barely trading 100,000 shares every 5 minutes, they would be much better off. And just by looking at volume again here on Friday on AMC, you can see that there's huge volume the entire morning. You had this huge breakout with almost 2 million shares in 5 minutes, and then volume just kind of died off, and this would have been your signal to probably stop trading and look for something better to do. Now let's look at a stock like Tesla, how you can use volume for like confirmations and for reversals. So I use this example in the intro for this video, but on Tesla, for example, right here, going back, let's look at the daily chart for a second. So looking at Tesla right here on the daily chart, when Tesla, sold off pretty drastically, it went from highs of, 1200 down to lows of 700. Right here around, January to February, they were clearly sellers at the 940 level. So going into this breakout right here on March 22nd, I said, all right guys, if Tesla can break 940, some continuation volume, I think you have huge upside potential. And look what happened when Tesla finally broke over 900. So Tesla, it came up, hit 940 right here, got rejected, volume wasn't really there. Tesla price started creeping up slowly and slowly. Then on this way up, you started going parabolic and the volume started increasing exponentially on the way up. And this is exactly what you want to see when you're trading a breakout for continuation. You want to see volume continue to rise on the way up. If you saw a breakout with no volume, it was just dead right here, that's a pretty big red flag that there's not really aggressive buyers in the market and could be a bull trap or a bear trap alike. Now moving forward a few days later, volume's also key to look for a pattern. Look at the volume on Tesla, huge volume. It's moving almost 900,000 shares every 5 minutes. Now it came up to this peak right here, it started dying down. If you were trading this breakout up here from $1,000 to 1030, but you could have also seen that was kind of forming a potential bull flag up here. And when you trade patterns, volume falling off like this is something you look for in a bull flag or a bear flag. So you came up to this high right here at about 1035. It starts decreasing substantially. And then on this breakout candle, you went from 1026 up to highs of 1040. You can see there's huge volume on this candle compared to previous candles. This could have been your confirmation to enter the trade. But unlike the previous day where Tesla, the volume just continued to go higher and higher after the breakout. You had this one green candle with some buyers and price dropped off pretty drastically. This is almost the exact opposite of what you want to see when you're trading a breakout for continuation. If volume continued to rise higher and higher, and let's trade 800,000 shares every 5 minutes, that would be a sign that there's buyers clearly pushing the market up and they're showing interest in the Tesla and trading Tesla higher and higher. But when you see this big green candle right here on the volume and then it drops off instantly, that's a huge red flag that price could start to reverse. And you could have taken a short position up here, knowing you saw this outlier of a candle. Buyers clearly aren't trying to keep price going up. They stopped showing up after that candle. You could have taken a short position right here, stop above high of day, and rode this down almost 50 points to like 987. Okay, now we're looking at NVDA on 124 for a potential reversal on what you'd be looking for. So you see NVIDIA selling off from 227 down to lows of 210, 208. Right here on the volume, you had this pretty substantial increase of volume on the 15-minute time frame with a pretty big lower wick. And when you saw this lower wick come in on the 15-minute time frame and the volume increased, that would have been a flag or a sign that there's potential buyers in the market stopping the price from going lower. Then you had a huge intraday reversal of about 40 points or about 30 points on NVIDIA, and you would close at high of day. Now, this is why you have to be pretty aware of the volume and what's happening, because if you weren't aware of the volume on this candle right here, you might have just assumed volume was going lower. And if you didn't take into account the price action, this big wick that formed on the 15-minute, you may have been surprised when prices randomly decided to reverse on you. But just taking into account volume and the candle that formed in the 15-minute, those were pretty big clues that price was starting to form a bottom. You could see a reversal intraday with this stopping volume. And one more final example here on Tesla on how you could use volume to your advantage and how people don't really use it that well. On this Wednesday right here, Wednesday was FOMC minutes. This is July 6, 2022. You have this giant void of volume right here, and price is moving clearly in a range between 680 and 700. Now people, they tend to fall in the traps of trading these, really choppy price action, and people don't know that there's an economic event like FOMC minutes about to come out. So they get stuck trading this really choppy price action. There's not really a lot of shares being moved. But personally, really don't want to trade on days like this. But another great example of using volume and how you could predict a reversal or slowdown in momentum. We're looking at Tesla here on July 8th. So right here, Tesla bounced off 726, it retested off it. Clearly huge volume coming in. We're trading about consistently 700,000 shares every 5 minutes. So there's clearly buyers active in the market. There's market participants pushing the price higher. This goes back to cause and effect and effort versus result. People have to put effort in to move the price. And clearly when there's this much volume, The market makers and participants are putting in effort to move price higher. So price continued to rally from 726 to highs of 660. And look what happened when price reached this key level of 763. Instant volume fall off. And this could have been a signal that maybe I want to start looking for a short position because sellers or buyers clearly just ran out of gas, ran out of momentum. I could start to look for a short position up here, maybe stop loss above high of day. And then you see this big red candle come in with some pretty decent volume. That could be your confirmation of downside. Following this red candle, volume just died off once again. So clearly there were no sellers in the market putting effort to move price lower, and there were no more buyers left in the market to move price higher. And so this is when price just consolidates sideways because sellers and buyers are at a mutual agreement on price, which is why you get consolidation. Personally, I want to trade in high volume environments where there's a direction, such as the early mornings or power hour. I really want to avoid this low volume shop as much as possible. And when you start understanding volume in trading, when you know people are active in the market and big whales are currently trading, it's going to set you up much better than trading in, you know, high consolidation ranges. You can easily get whipsawed in either direction. Now, if you enjoyed this video, learned anything, just drop a like and comment. You got any suggestions for me, just let me know in the comments below. Thanks for watching.